All right, how's it going, guys? Welcome back to another video. In this video, I'm going to be talking about my new favorite trading confluence. Of course, I'm going to be talking about the inverse fair value gap. Now, you guys probably know I'm not a huge fan of smart money concepts, ICT concepts, but I am a fan of the inverse fair value gap. On the screen here, you might be wondering, what these arrows are. This is my own custom iFVG algorithm. I haven't seen this done before, but this is a real-time iFVG algo. I'm planning on releasing this inside of the Pro Discord. And also, let's actually go to a futures chart because I know we have some futures traders in here. This works very well on like NQ as well. On a lower time frame. So for all my futures traders out there, this strategy works very, very well for futures trading as well. Like legit, this is on a 5-minute. It's catching these moves beautifully. Like I said, the algo is not out yet, but that's just a little sneak peek. So let's start with what a fair value gap is first, and then we'll get into inverse fair value gaps. So a fair value gap is made of 3 candles. Okay, so let's say we have one candle, right? One candle, we have one candle there. And then we have a massive bullish candle, right? Huge bullish candle, right? 2 candles right there. And then let's say we have a third bullish candle in this scenario. Okay, something like this. So this gap here between the top of the first candle and the bottom of this third candle is referred to as a fair value gap, right? A fair value gap. So what does this mean, right? What does this gap here mean? Well, in theory, right? In theory, it means that there is liquidity here. Liquidity, for those of you that don't know, I'm literally going to make this video as if I'm talking to, a school child, okay? So liquidity equals open orders, okay? Open orders. Or, apologies for my shit handwriting, or money, okay? And money and open orders is what actually moves price. Price seeks liquidity in the markets, okay? So a fair value gap, in theory, is liquidity. Is this true? Okay. Are there actually open orders in a fair value gap? Okay. You need level 2 data for this. And this is just the truth. Okay. You might say there is a fair value gap here, so that means price will react. You don't know if there is actually liquidity there unless you have level 2 data. I don't make the rules. That is the truth. Sorry to burst your bubble, but I don't use level 2 data to trade. We can still use this without level 2 data. And that's actually a reason that I'm a fan of the inverse fair value gap, because you can clearly see order flow shifting without that level 2, level 3 data, which is very, very important. But again, we're talking about FVGs. So there is, in theory, liquidity here. Okay. Now, because so many people are setting limits at this fair value gap, there is going to be liquidity there. Most retail, like me and you, who are trading fair value gaps, are going to enter based off of a fair value gap. So just the thought of there being liquidity in the fair value gap will make people enter at the fair value gap, therefore creating liquidity. So it's kind of like a fucking paradox of some sort, right? But because people believe that there's liquidity there, they're going to put orders there, meaning price will oftentimes react off of fair value gaps, just like price oftentimes reacts off of the golden pocket fib, because so many traders use the golden pocket fib for an entry that oftentimes there is a reaction there, just by extension of people entering at that level. So I hope that kind of makes sense. But anyway, this is a fair value gap. Let's look at an example of a fair value gap, okay? I'm just gonna look at some random examples. Okay, so right here we see a fair value gap, right? You can see 1 candle, right? 1, right? This is the 2 candle with the fair value gap, and 3, this little candle right here, all right? And 3, and you can see we have this gap in price, and price comes down to this level and reacts from it, okay? So that's one example of a fair value gap. Okay, here is an example of a bearish fair value gap, right? We have 1 candle right here, 2 right here, this big bearish candle, and 3 right here, creating this gap, right? Creating this gap. And what does price do? In this case, price reclaims this bearish fair value gap, also support, retests, and continues higher. So price will react to these levels. Now that you know what a fair value gap is, we have to talk about what an inverse fair value gap is, okay? An inverse fair value gap is actually what I just showed you. Okay, so this would be, let's say you are in bullish market structure, right? Price is creating higher highs on a 4-hour time frame, right? And you see this bearish fair value gap that price reclaims. This bearish fair value gap right here, this bearish fair value gap, right? BFVG, bearish fair value gap, now becomes an iFVG, becomes an inverse fair value gap because you have reclaimed this to the opposite side. Okay, let's take another example of a bullish fair value gap, right? We have a bullish fair value gap. You can clearly see the gap in price, right? 1 candle, 2 candle, 3 candle, and we close below this fair value gap. This now becomes an inverse fair value gap, right? This becomes an inverse fair value gap or resistance. Okay, so that is an inverse fair value gap. Okay, now let's get into the good stuff. Okay, this is the juice. Hopefully you've been watching along and taking notes, because half of the people have already clicked off of this video because they have TikTok brain rot and they cannot sit still for literally 10 minutes to learn a strategy that might change their life forever. Don't know why, but that's the way it is. Less competition for us, more exit liquidity. So that's good. So how do we use iFVGs? There are two main ways that I use iFVGs, okay? Or there's two types of iFVGs. Okay, two types of iFVGs. Now, where did I get this from? I made it up by studying price action for the last 3 months. So when people start talking about mild versus strong iFVGs, maybe it's already a thing, but I'm pretty sure I came up with it. But we have mild and strong, okay? Mild and strong. Now, keep in mind, when you are using these for an entry model, you always want to make sure you have a higher time frame bias in mind. Before you click off this video and think, what the fuck is a higher time frame bias? Go to a 4-hour time frame, look to see if price is making higher highs or higher lows, okay? That's it. People like to make this more difficult than it is, okay? But your bias is gonna be long if the chart looks like this. Obviously, protected lows, right? Protected lows. And your bias is going to be short if your 4-hour looks like this. We see that we have a bullish bias, okay? We're making higher highs and higher lows. So my bias is bullish, okay? That's it. So now that we have a bullish daily bias, it means we're looking for longs, meaning we're looking for bearish fair value gaps to get inverted. And by inverted, it essentially just means reclaimed, okay? So let's say we have one candle, right? We have one candle, and then we have, bearish candle, boom, big fat red dildo. And then we have, another bearish candle, okay? And then this gap is going to be our bearish fair value gap. So what we're looking for, if our bias is long, is we're looking for a reclaim of this bearish fair value gap. So where do we determine whether it's been reclaimed? Because for all we know, price could come up to test this fair value gap and close below again, right? Because technically this is still resistance. So when is this actually considered a reclaim? So it is considered a reclaim when you get a candle close on whatever time frame that bearish fair value gap is on, a candle close above this fair value gap. So if this is the fair value gap here, you want a candle close above this level here. Right, so something like this, and then you get one more candle, boom. The candle that closes above this bearish fair value gap now inverts this bearish fair value gap, and you can look for retest for long, or a market order, which is what I would recommend, as soon as price closes above this level, right? You enter a market order here with your stop loss below this bearish fair value gap. Now, this is what I call a mild iFVG. A mild iFVG, because we didn't reclaim this with one bullish fair value gap. We just reclaimed it via candlesticks, right? So 3 to 10 candlesticks, we've reclaimed this bearish fair value gap. That is still a strong bullish signal. And if it aligns with our daily bias, if it is near our entry zone, for example, your golden pocket fib on a higher time frame or a key support level, you can enter the trade here. So let's take an example, okay? Let's take an example of a mild iFVG. Okay, so you can clearly see we have this bearish fair value gap. We are in bullish market structure because we're making higher highs on a 4-hour time frame, right? Until we lose this low, we are technically at bullish market structure. We are also at a key fib level. If we grab our fibs, we are at our optimal trade entry, and we are retesting this support zone, right? This is why it's important to have lots of confluences, guys, which I talk about all the time. By the way, if you guys want to follow my exact trades where I'm actually posting my setups, that's going to be available in the Pro Discord. First link in the description below. So we've established that we're going to be looking for longs at this level. Our bias is bullish, and we get that bearish fair value gap, or we get that bearish fair value gap right here. You can clearly see one candle, two candle, three candle, and you can see that we reclaimed this bearish fair value gap with a candle close above on this candle. Right on this candle. Maybe you can go down to a 1-hour time frame. Right, we are on a 4-hour time frame. This is a little bit better, right? Let's take the 1 hour, for example. Okay, candle close above this 1-hour FVG. You can place your stop loss below, and we're going to be targeting that external liquidity, right? These highs over here. And this is how you can get those 1 to 3, 1 to 4 RR trades pretty easily. You can even try to take this one right here, which would be a 1 to 5.5 R trade. Okay, that is an example of a mild iFVG because we reclaimed this level, but it wasn't with a strong bullish fair value gap. It was just a corrective reclaim of this level. Now, a strong iFVG, okay, that's a mild. A strong iFVG, this is even more Confluence. If you see this, would be, again, if you're looking for longs, right, you would have a bearish fair value gap. We're going to do this quick. We have a bearish fair value gap, 2, 3, right? Bearish fair value gap like this. And you would see another bullish fair value gap immediately reclaiming that bearish fair value gap, right? So this is our bearish fair value gap right here in between these 3 candles. And we've created within that bearish fair value gap another bullish fair value gap. This is kind of like a reverse sweep, all right? So let's pretend it's the Warriors versus the Cavs, 2016 finals, whatever fucking year that was. Let's say that Golden State was up 3-0. I know they were up 3-1. Let's say Golden State is up 3-0 and the Cavaliers come back. They come back from being down 3-0. They tie it up with 3 straight wins. Obviously, it's best of 7 to push it to a game 7. That is what's happening here. We're seeing a reverse sweep, being down 3-0, and we're making that comeback. Okay, well, we're making that comeback with that bullish fair value gap overlapping that bearish fair value gap. Now we have a shit ton of liquidity here. So we can either enter a market order long if your daily bias is bullish, always remember, with your stop loss below this low, or we can wait for a retest of this level, which is now going to act as support, again, to target those external highs. So there's actually a beautiful example of this today, I believe, on Bitcoin on the 15-minute. This is a little bit different because our bias is bullish, but we did see a sweep of that 15-minute high. You can see we had that bullish fair value gap, and we immediately saw that bearish fair value gap right below it. That's going to be our entry, and you would target these lows. In fact, we saw it way back here as well. Another example, right? Bearish fair value gap here. In this case, it was more than 1 candle, but we reclaimed with another bullish fair value gap. Close above this level. That's where your stop loss is going to go, right? Targeting external liquidity. All right. Again, 3.2 RR. We entered along here in the Discord. I posted this in advance, and this was our long entry, right? Bearish fair value gap. This is an example of a mild iFVG, right? Multiple candles closing above. We reclaim at a key support, at a key fib level, targeting these highs, and that was a 5 RR if you had sold at this high right here. Okay, so that is it for the iFVG method. Definitely a great entry model. You just need to use higher time frame bias. Please have your confluences in line first. A good way to make sure you're using these correctly is just make sure when you're entering via this model, make sure you are in your optimal trade entry. So at the golden pocket level or below, that will confirm that you're at least taking longs in discount zone. I don't want you guys just taking random iFVGs whenever you see them. It's important that you see sweeps, you have your key fibs, you have your key levels to make sure your confluences are met. If you don't have your confluences met, this isn't going to be profitable in the long run, but it is a damn good entry model. Ton of stuff on the way, so make sure to stay tuned, and I'll see you guys next video.